Most traders open a chart and feel overwhelmed. Candles move fast. Price spikes without warning. Entries feel late, stops feel hunted, and after a while, a dangerous belief begins to form. The market is random. But randomness is only the name we give to patterns we don't yet understand. Because if the market were truly random, price would not react at the same levels again and again and again. Yet it does, across currencies, across indices, across decades. This video is about why. Not indicators, not hype strategies, but the mathematical logic that quietly shapes price movement behind the scenes. Fibonacci and harmonic trading are not tools for prediction, they are tools for recognition. They reveal where price is stretched, where risk becomes unbalanced, where institutions quietly step in. This is the language of precision trading, and once you hear it, you can't unhear it.
Every market candle represents decisions. Someone bought, someone sold, someone hesitated, someone panicked. Multiply that by millions of people and you get price movement. Humans behave in patterns. We always have. We fear loss more than we love gain. We chase what's already moving. We hesitate at uncertainty. We react emotionally at extremes. This is why markets form waves: impulse, correction, expansion, exhaustion. Fibonacci ratios don't control the market, people do. But Fibonacci ratios describe how people behave collectively. That's why the same ratios appear in nature, architecture, biology, financial markets. Institutions don't believe in Fibonacci. They observe reaction clusters. They know where retail traders enter late, stop losses are placed, liquidity is stacked, and Fibonacci levels sit right in the middle of those zones. Let's slow this down. Fibonacci is not something you use, it's something you measure with. The single most important rule: if you get this wrong, nothing else works. You only draw Fibonacci on a clear, impulsive move. Not chop, not noise, not emotion. Impulse shows intent. In an uptrend, price moves strongly upward, then pulls back to rebalance. That pullback is where professionals look. The reality of Fibonacci levels. Retail traders treat Fibonacci like exact prices. Institutions don't. They see zones, areas, probability clusters. 38.2% is shallow, weak hands exit. 50% is balance, indecision. 61.8% is premium logic. 78.6% is deep discount, fear peaks. Price slows here because orders accumulate. Why price reacts, not reverses. Important distinction: Fibonacci doesn't cause reversals. It causes reaction opportunities. Reversals require liquidity sweep, market structure confirmation, time alignment. Without confirmation, Fibonacci means nothing. This is where amateurs separate from professionals. Confluence is everything. A Fibonacci level alone is weak, but when Fibonacci aligns with previous high or low, trend line, range high or low, higher time frame structure, that zone becomes heavy. Institutions don't trade often. They wait for stacked conditions. Fibonacci extensions explained slowly. Extensions are misunderstood. They are not targets pulled from thin air. They represent where price becomes statistically stretched. Common extension behavior: 1.272 equals partial profit. 1.414 equals momentum hesitation. 1.618 equals exhaustion or reversal. Price doesn't stop there because it's magical. It stops because orders were planned there long ago.
With Chart Authority Labs, all doubts will be cleared, and your trading journey will be both scintillating and mesmerizing, with ensuring you put your best foot forward with each step.
Let's clear a myth. Harmonic patterns are not shapes, they are rules. Rules about how far price pulls back, how far it extends, where imbalance peaks. Every harmonic pattern is built from Fibonacci ratios. No ratios, no pattern. Why harmonics feel too perfect? Because they are selective. You don't find them every day, and that's the point. Institutions don't need many trades. They need asymmetric ones. Harmonics offer clear invalidation, tight risk, high potential reward. Understanding the core patterns, deep. Gartley, a trend continuation pattern. It forms when the market pauses, not when it breaks. Bat, deeper correction. Traders gives up. Institutions step in quietly. Crab, extreme extension, emotional climax, often forms tops and bottoms. Shark, aggressive, designed to trap breakout traders, fast and violent. Each pattern exists because retail psychology is predictable. Subscribe to be among the 1% of profitable traders. This is the professional layer. When a harmonic completion aligns with Fibonacci retracement, structural level, liquidity sweep, risk collapses. You're no longer guessing direction. You're defining invalidation. Professionals don't ask, will this work? They ask, where am I wrong? That's precision trading. Why most traders still fail? Because knowledge without discipline is useless. Most traders force patterns, enter early, over-leverage, refuse to accept invalidation. Institutions are emotionally neutral. Losses are data. Wins are execution. Survival comes first. If you take nothing else from this video, remember this. The market doesn't reward intelligence. It rewards patience. Fibonacci and harmonic trading are not shortcuts. They are filters. They help you trade less, think clearer, risk smaller, execute calmer. When you stop chasing movement and start waiting for precision, the market stops feeling hostile. It becomes readable. And that's when trading changes forever. Don't forget to like, subscribe, and follow Chart Authority Labs for more.